Welcome, everyone. I'm Angelo Robles, and welcome to my Family Office TV. I'm very fortunate today to be leading an interview with someone that I just met a couple of months ago. Many of you are now familiar with my now iconic, at least to me, my trip to Europe, primarily Central Europe, back around the holiday season in December. And among the most enchanting and incredible people that I met in this amazing trip. And by the way, a shout out to the person that made it happen, made our introduction happen. That would be Alexander Galambos. Alexander, I'm sure you're going to watch this. You're an amazing man, a great connector, and thank you. But our special guest today is, and I just love saying her name. What a first name like Italian or like Angelo, that's obviously Italian. That must be a little bit in my blood somewhere. So our special guest today is Donatella Ciccarelli. And Donatella is among the most talented, deeper thinkers and critical thinkers from a global perspective about investing, having been entrenched in a significant, very high level European family. That's one of the most successful European families, basically running the family office, and more importantly, the role, which is part of today's discussion, as the CIO. So we're going to have an impactful discussion with a very thoughtful CIO, effectively of an international investing family office, which I know for many of you is probably the ultimate of an interview or someone that I could have on. And joining us from Milan, Italy, Donatella, welcome.
Thank you, Angelo. Thank you. Hello to everybody listening.
Thank you. It's very kind. And I really enjoyed my trip to Europe. I look forward to going back. And it's going to be very hard to keep on meeting great people that could keep up with you. I'm going to have to scour the world and see if I can make that happen. I don't know. But importantly, we did met. I learned so much. And now I would like to share by asking you questions with my audience. So from my perspective, I think it's important to start. If you're going to talk about investing, there has to be some level of an understanding as to what's going on locally, regionally, and really around the world. So to me, that takes the conversation to a degree to economics and to big picture macro. Are these things that you look at in helping to formulate your tactical and strategic strategy, or do you play an extremely long game and do not necessarily look at what is exactly going on minutia in economics and macro in the economy, broadly speaking?
I think that overall, for the asset allocation, looking at the macro and actually understanding the drivers of certain developments at a local level, meaning at a regional level, is extremely important. Some people would tend to say, understanding the GDP development is not so important, but it is important. It is important because GDP growth means earnings growth. Also tied to the GDP and the macro development are variables like inflation and repercussions on interest rate policies, i.e. you have an overall connection of different variables that you certainly have to take into consideration. Now, economists themselves tend to say, it's not me, that the economic way of assessment is a backward-looking indicator. I actually personally do not agree with that. And I think that assessing the macro is very important.
I agree with you, but yes, correct. There are some people and even family offices that may literally take decades-long views and are maybe more active directly investing in private companies where they may look at it just a little bit. And I understand their perspective, probably in their perspective of dynastic thinking. It is not as applicable in the day-to-day. To some degree, I almost respect that because it makes their life easier. You and I are, you could argue, burdened to some degree, but also hopefully we get insight from the nuances of the numbers and what they mean. But we all understand there is a difference between theory the economist, and we respect their intelligence and their capability, and someone who's actually in the trenches, a trader, a real investor. And make no bones about it, 99% of the time, there is definitely a difference. One is talking and one is out there making money. Related to that, and you hinted at it, big aspects are going to be inflation, which was raging, I guess you could say, especially a year to a year and a half ago. There are some that will feel it is still in the core essentials like food and housing, way underreported and still out of control. But raising interest rates is a way to combat that, but that has its own faults. So how important to you is the dynamic of inflation and rising interest rates?
Well, let me first come back to one of the aspects you cited. In fact, the macro assessment for direct investment is in fact important up to a certain point. I agree with you. And in fact, I was talking about the asset allocation, so looking at mostly the liquid part. In fact, as far as the illiquid part is concerned, you have to look, for instance, at private credit, private debt, where higher interest rates actually can mean higher returns for the investors. Because as you know, the interest rates used are of variable nature. So regarding interest rates overall, you have to be very careful what kind of asset class you tied to this. On the other hand, though, if you have an inflationary situation, higher interest rates, and you go into a slowdown or a recession, obviously this can mean default increase. And that is, of course, not a positive development. So I think that, again, you have to look at the different asset classes and assess the repercussion on the different investments of certain macro variables and developments.
Of course, there's been 4 research reports that headed into what are concerns of family offices heading into 2024. UBS was perhaps the most prominent, but there were others. These are big institutions with good depth and connectivity with multi-billion-dollar family offices. Off the top of my head, the big 3 concerns heading into 2024, and I would effectively concur. It was geopolitics, number 1. It did vary a little bit by region. It was recession concerns, number 2, and a topic we already covered a little bit, inflation, because of the impact that does have, and the erosion of purchasing power, number 3. Given the fact that we already tackled a little bit inflation, sticking to the first 2, geopolitical concerns, we have 2 wars going on. We have a lot of challenges with governments deeply in debt. We have a lot of problems, to say it lightly. But recession, I don't know. Here in the US, you look at the stock market, although a little bit misleading because it's driven by a small group of companies, but some of the market indicators don't look that bad. It's getting harder and harder to understand how the world works because what we learned in school and our past experience, some of it doesn't appear to be applying anymore.
You're really right. Now, the first thing regarding, first of all, we have had quite a strong inflationary environment, as you know, in 2022. And as a matter of fact, the slowly retreat of the inflationary pressures has led to an amazing performance of stock markets. This is the first thing. So inflation doesn't necessarily always mean a big correction on the markets, especially the equity markets. Regarding geopolitics, I think that this kind of aspect for investors is becoming more and more challenging. It is extremely difficult to foresee and price in the certain political aspects, as I think it is quite impossible to know at the end of the day what, just to cite an example, Putin has got in his mind eventually. We can just work with different scenarios, but that becomes extremely challenging and difficult. Recession, as you know, the market has been expecting a recession for a very long time. In fact, it takes quite a long time for a recession to come after the first increases of interest rates. But in view of the growth and the strength of the US economy, especially, the European economy is quite weakish, in fact, but the US economy is not. So the question is a recession at all coming? And also, I would cite one thing. I was just in an asset allocation call before joining your call, and we were just discussing, the situation that has to do with a sort of a hybrid warfare, which means that, nowadays the pain is not inflicted anymore only through tanks, planes, guns, rockets, but also with the weaponization, for instance, of food and energy prices that can far more hurt the civilian populations. And also, if we go even more far off and we look at the threat to the undersea internet cables, if you look at this cold war in hot places like Africa and the Pacific, then we can say that, just foreseeing outright a sort of the geopolitical impact on certain investments and asset allocations of many family offices is quite challenging, is quite difficult.
Indeed, it's a little off topic, but we'll take it back a little bit to geopolitics and the bigger picture relative to the economy and investing. And that would effectively be the US. The US is dominant. It has many things that play to its advantage. We could go on and on, contract law, our military, but really, let's be honest, a lot of it comes back to, since Bretton Woods in the mid-40s after World War II, it's the US dollar has been king. So maybe my pronunciation is not the best in the world, but hegemony, the US dollar is king, it's dominant. We were kind of in a unipolar world. And now we're going more into not even just bipolar with China, but I could actually argue unipolar with multiple. We see the rise of the BRICS, countries banding together to not be under the thumb, I guess you could say, as much of how overbearing, some would argue, around the world, the US government and quote unquote the dollar is. And you use the word weaponizing. I mean, come on, there's no question. And I'm an American citizen who's kind of on the conservative side and a libertarian, but of course that all has been quote unquote weaponized. So from someone who's intelligent from a European perspective and invests globally, the US dollar is not going to be the all dominant forever. How do you think in the coming years it could play out, and how would that impact how you allocate in a portfolio?
Quite frankly, I've read over and over again studies regarding the death of the US dollar.
For 20 years?
I don't think that we can just judge it or assess it in this outright way. So the preeminence, first of all, the preeminence of the US has been there for the last decades. And as far as I can see, in this multipolar world, as you rightly say, the US continues in its preeminence. And if you look at the market, the US market, actually, we can see the same. We can be critical of the Magnificent Seven, the fact that all the rest of the market is not performing as well. But as a matter of fact, it has a very, very strong traction. And also, my next question would be, what is the alternative really to the dollar? Is that a Bitcoin? Is that
is the question.
Is that the euro in a situation where you have yes, a union, but with so many countries. And in the US space, and the dollar space, you have one country. And does Asia really represent the real alternative? I would say no to the US. It is a pole. It is in a polar world, another region that is rising. But I wouldn't say that this preeminence is coming to an end soon. So, and coming to your last question, sorry, regarding the asset allocation, what would I say? For instance, from a European investor point of view, I would certainly see the whole spate of investments in the illiquid markets as and of course in the dollar, as a diversification factor in the asset allocation, i.e., keeping a strategic exposure to the dollar as compared to other currencies, i.e., not hedging. I am quite personally critical of the need for hedging, especially in a big asset allocation. I would rather go for strategic positioning.
Interesting. And yes, I guess hedging means it's a cost associated with it, which could dampen returns. And sometimes when returns are roaring, you kind of have to let that run because that's a good opportunity. And yes, you can make the argument, what is going to replace the US dollar? If anything, it could be a basket and SDR, quote unquote, inclusive of the dollar. But I don't see that happening in the immediate near term. And our Americans, and I'm specifically Americans, but really Western, but mainly Americans, we're probably 95% dollar denominated in our equity positions. And I could argue that would be a little too extreme. Could there be some currency plays with the Norwegian krona, the Singapore dollar, and obviously the Swiss franc has quote unquote a little bit of a hedge? I could see that, but none of those three will ever in the foreseeable future. They're way, way, way too small to ever be quote unquote a global currency, which likely means what you're describing is accurate. But the BRICS banding together and possibly some of it backed by a hard asset like gold, that would get interesting. And then it brings in oil and energy, and that's been weaponized. But again, we could go on and on with a very deep geopolitical and economic discussion. And this is why, as a single family office or family office in general, yes, you do have to keep abreast of these issues. Let's change the direction a little bit. Since my primary focus is family offices, specifically the single family office, and that's a lot of your background as well, putting on the role of especially the CIO and or CEO. At the end of the day, it's going to be up to the family. Who's the decision maker or group of decision makers in the family? What are their goals, their liquidity needs, their time horizons? How important would it be for the CEO, or let's combine them and make them one, the CIO, to have clear written understanding about what expectations are, which I'm assuming is converted into an investment policy statement and an asset allocation strategy that they kind of sign off on?
That is extremely important. In fact, I was a CEO and also setting up, obviously, the asset allocation strategy. I think that to understand the strategy, understand the purposes of the family is of paramount importance. And in fact, the strategic asset allocation is what is discussed and approved, discussed with the family and approved by the family. And then you go into the execution. Obviously, it is the management of the family office that is preparing the proposals, but this is then ensuing after long discussions with the family in order to understand all the aspects and the needs of the family, and as such structure the approach and also structure the minimum returns, the mid-term returns, and the long-term returns of the portfolio.
So to me, that relates, I guess, to what I said. It's having a process. I think too many family offices are undisciplined. They don't have a formal process, which of course you always need to update. But if something were to happen or someone goes down, by having quasi-standard operating procedures, others in the short term at least could step in. So, okay, you have the investment policy statement that sets certain parameters, the asset allocation strategy, it may be tactical, satellite, or more commonly, like you said, strategic. But now it is time to execute. And I guess that's where it gets interesting. If you're a seasoned executive, do you find it cumbersome if the family is so hands-on that anything we look to directly invest in or being LP, we need to run by one decision maker or multiple in the family? And what do you think of, and be honest, good or bad, investment committees?
I think that every committee, and certainly the family, and the management of the family office, they all make obviously a lot of sense. But I think that there must be clarity on who is doing what.
Mhm.
I think that having a mandate and setting up the strategic asset allocation is enough for the management of the family office to execute on it. But if at every single decision you have to ask multiple people, I think that the work of the family office is not going to be properly done, and the performance is going to suffer. In fact, I'm a big believer in processes and setting up proper due diligence processes, especially. And you have to think that within the family office, you have people responsible for executing certain strategies. You have the specialist professionals. And you cannot just say, wait, I have to ask 1, 2, 3 other people for their assessment. Also, they're not expert, and they're not supposed to be expert on a certain field. And for this reason, you just set up the strategic asset allocation, and then you fill it with specific investments in specific buckets. And this is done by the specialists and cannot be decided by too many people. There must be a CEO, a CIO, or a small group of people that is going to say, okay, that's what we're going to do. And it goes through after the managers have just proposed the different investments and done the due diligence along the way.
I completely agree. I know it sounds good from afar that we have a lot of people that look at things and we jointly make a decision and it's groupthink and bottoms up. And there are times in family governance where that is important. But in something like investing, having more decision makers does not make you make a better decision. Jeff Bezos, currently, it may change tomorrow, the richest man in the world of Amazon, believes in what's called the one pizza rule, meaning really under 3 people, probably 2, are going to eat a pizza, make a decision, and we don't need to have 5, 10, 15 people. The problem, I think, with a lot of family offices, and I know they need to be careful on decisions with high consequences. I respect that. But that being said, they're too slow. Like, you think an advantage of a family office would be they're not an institution. They could think out of the box. They can make quick decisions. They could invest in verticals that maybe institutions for a variety of reasons can't. Yet too commonly, I see family offices. Unfortunately, most non-family executives are just very careful. They're very worried about their job. They want the safety in making a conservative decision that may not make them great, but it's probably not going to so-called get them fired. I think they're too careful. Why don't I get your feedback on that, and then we're really going to dive into your sourcing and diligence on managers.
Well, I think that once you set up the strategy in a different bucket, then the strategy has to flow, has to go. Of course, new investments or new fields of investment require a discussion before they are executed, in order to make sure that you have set up the processes, obviously the targets and the purpose, and the appropriate professionals, just to make sure that these new investments are performing well. So in that respect, I think that you have to differentiate. You cannot be always too slow. And the aspect of not wanting to take risk is something that I do not understand so much. What you have to do is, in my opinion, is to make sure that whatever you do is going to protect your capital, and that you're not just improvising things too quickly, so that you might have a permanent loss. For instance, one of the most important aspects of investing in private markets is to have a very stringent due diligence process that can take 6 months, 1 year.
But then, we're getting to that. Trust
where then the managers very, very well, you know what they're doing, and you can follow. As a matter of fact, the GPs, of course, they are gonna bear the responsibility for the investments that are made. But actually, through a stringent due diligence process, you can really avoid big pitfalls and permanent loss of capital. This is just an example. On top of it, what you do is that, especially for the private markets, for instance, you just set up a program so that the managers know, for instance, what to do each and every year, how many investments they want to perform, they have to perform, and so on and so forth. Something different is in the direct investment field. If you have a principal that loves to do direct investments and buy stakes in companies, that kind of aspect can be done in a different way. But still, you need to make sure that the due diligence processes are in place. So I'm a big fan of this. No improvisation. It can be very dangerous.
Yes. I mean, I have a saying that relates a little bit to that. Besides my saying that undisciplined family offices don't work, most single family offices don't last 15 years. And the reality and mathematical reality is most are average. A certain percentage will be good. And in my opinion, having traveled the world, having met with 2,000 single family offices, about 3% are great. And I tend to notice that very quickly. And you're in a little different role in your career now. But when I met you and we were having the conversation, I already knew from my experiences and hopefully a level of competency that, boy, this Donatella, any family office that she's a leader in, it's going to be great. And we disagree on certain things from an investing perspective, and that's okay. A way that I rephrase that a little bit is mediocre family offices want to be left alone. Good family offices want to be mentored, and great family offices, very few, want to be told the truth. They may disagree with that truth, but they have competency, they identify their blind spots, they move ego aside, and they have a results-driven focus that is commonly also built around access, their network, their mentorship, and their capability of people around them. Now we're getting into the heart of it. So it's overly simplified, but some family offices are more focused on direct investing, and the majority, I would say, are more focused on, why don't we outsource to what we deem to be best in breed relative to our focus. Most family offices do little combinations of both, but I would say the majority lean towards, we're going to have a relatively lean team, which I know you disagree with, we'll get to that. and let's outsource to the best managers. So now the issue is, okay, you have the investment policy statement, you have the asset allocation. How do you decide on sourcing managers? Where are you getting your information from to begin the diligence process with your team?
Yes. Now, I personally, I do believe that you do not need to have, but it's a matter of preference, obviously, necessarily within the institution, own teams that manage, for instance, liquid assets. I think we are in a world where you have all kinds of strategies, all kinds of managers in the liquid and illiquid space. So you can certainly outsource the different strategies to a selected portfolio of managers, i.e. being a manager of managers. That is the first thing. I think that it is actually to source the opportunities. It's not so difficult in a way that whatever you do, be it in a liquid space, in the illiquid space, and also direct investments, as soon as the market knows that you are performing certain investments, then you will have plenty of opportunities to choose from. But the point is exactly to choose the right ones. So you say no, 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 very often. And it is much better to say no than to be too open and really be very strict in what you're looking for. That's the reason why the different teams, in my opinion, have to have a stringent strategy, knowing what they are supposed to do. And that is the result of the strategic asset allocation, if you like, with the tactical asset allocation side put together. And this is the reason why. And so being choosy and having deep understanding and due diligence processes in place can allow you to avoid the pitfalls and the failures within the portfolio. And it's possible because I have experienced that.
Oh, of course. So we're going to get to that because I think they'll be important as we're helping other family offices. Again, you're a top level one. So in terms of you're building a team that is going to, some people, we may call it an analyst, you may call it a managing director, but you're effectively building an investment centric team, even though they may not be pure direct investors in the traditional sense of the word. They have the capability of sourcing and of doing diligence and following a process that will then circle back to you so decisions can be made on executing on that part of the quote unquote asset allocation. If you could share with our audience what it's probably 200 plus questions, so we can't go through all of it, but what does some of that diligence look like that's important to you with your team and then you making a decision?
It varies. It varies very much. Obviously, I would say that especially for the liquid side, extremely important is the track record, meaning how long has this manager been managing for and how successfully, how many funds and so on. So for instance, in the liquid space, first-time funds are very difficult to subscribe, to commit to, as we do not know if the team is going to stay together, if the whole venture is going to work out. So there is a riskier profile, if you like. In the liquid space, in fact, you have the so-called questionnaire that you send out, and then you do follow up, and you make sure, obviously, that you also visit the managers and that you just look at the people face to face. And actually, in a world of remote working, looking at people in the eyes is for an investor extremely important, being liquid, illiquid, direct investments, or whatever form that might be. I do believe that this kind of procedures can really lead to a lot of success.
You said a lot there that I want to dive into. And we also have to realize, we see it here in the US and around the world, that certainly certain GPs and funds can be fraudulent. So understanding accounting and other diligence and verifying is very important. It's similar when you're making direct investments into a private company. Just because you're getting a profit and loss statement, a cash flow statement, et cetera, doesn't mean that it's 100% real. You need to verify it with bank statements and other methods, which we won't bore the audience and get into. But this is really important. You hinted at it earlier. I'm going to change your words a little bit, but let's just say you're looking at a given vertical to put an asset allocation in, and your team is sourcing managers, and they come across a good manager who appears to check the box, but there could be something better out there. So what I find that really, really good family offices do is they focus on the best opportunity within some level of reason possible. They don't settle for what's okay. Well, this is a big name. Institutions invest in it. We're going to be safe, but they're not the best in my perspective. So I go back to sourcing, but I go back to diligence. And how are you, because if you're only picking big name managers, a lot of them are asset gatherers. They're focused on institutions. They're not tax sensitive, which may or may not be important. Like, how are you really narrowing down to pick what you deem to be at that moment the best in breed?
Yeah, I just give you an example, maybe just one of many. For instance, I want to invest in distressed debt. So one possibility is to look not only at the manager that can source the different issuance in a country or different countries where these distressed positions are in the banking balance sheets. But also, one thing that I should make sure that exists within the manager and its platform is the fact that there should be a team that is managing the collateral, because that is very important. Because very often you have a distressed debt with, I don't know, hotels behind that are half finished. Someone will have to make sure that you finish the project and that you sell it in the market. That's how you really make money. So making sure that these kind of resources are given with a manager, it is very important, just to give an example. But this varies from the different kind of strategies that you necessarily have to put into a certain bucket. But just to show you how critical you have to approach each and every investment, assessing the risks ex ante.
So if you're building an investment team, and whatever we want to call them, analysts, do you have them very, what I would call, vertical specialized, private credit, distressed debt, long short managers? And if so, what would be among the most common that you had? Which ones? Was it 3, 5, 7, or did you have individual analysts in various verticals for 20 or 30?
Yeah, I think that you have certainly to have different teams for the liquid and illiquid space. And you don't need in the illiquid space every specialization and for that one person. I think that experienced people can really manage a lot. We are talking here again a manager of managers, and you can manage many managers, not having an incredibly big team, in my opinion. But the team must be seasoned, must be experienced, and I do not see necessarily the necessity personally of having the junior of the junior of the junior of the junior, but rather having 2, 3 specialists that really can make the job, and having then 1 or 2 assistants that support the whole thing. So quite simple structure.
And if you don't mind me, at the peak for the significant family in Central Europe, which is very significant, approximately how many LP interests broadly during a year would they have? 20, 50, 70?
You mean an average family office, single family?
More so a larger scale one, like one that you represented. Were you
Okay.
managing 20 different LP interests or more?
More. I mean, big family offices. I just spoke. It can go in the region of 100, depending
Wow.
on how long a manager, a sort of a family office has been operating. But if you look at more than a decade, and having a program, that is important. Having a constant program will lead necessarily to maybe not managers, can be different funds, maybe less managers, but at the end of the day, you have different strategies. Diversification is extremely important. So you can have important portfolios, and that's why I believe it's so important to have seasoned and experienced managers of managers so that they can really cover a lot and really manage and really follow this portfolio, monitor the portfolio rather accordingly.
Wow, that's a lot there. So, like you said, a multi-billion-dollar single-family office may very well have, like you said, and I've seen a couple here in the US, 80, 100, or quote unquote more outside interest. So that means they need to redo diligence every year on those managers. And I'm assuming you're getting in some and getting out of others. But if you're getting in certain managers, the money's going to have to come from somewhere. So if it's not being pulled out of cash, which US treasuries are relatively attractive short term right now, you're taking money out of one manager for what you deem to be a better opportunity.
First, we have to distinguish between liquid and illiquid buckets. In the liquid buckets, actually, I would say that I would follow an underperforming manager, which can always happen in between in the long run, for 1 year. If within 1 year, a given manager is not going back to the expected performance that should come, especially if I look at the rates in the market, the situation of the market, of the sector they're operating, or whatever that might be, then of course it's going to be replaced. No questions asked furthermore. Regarding the liquid space, obviously, that is not so easy. I know that the secondaries in some phases of the market become more and more attractive, but actually you have to do your due diligence in the liquid space for in a very in-depth way before you do the investment. Because once the investment is done, it's a little bit like a marriage. You don't get out so easily. And actually, of course, you can sell, it's secondary, but usually you are in for the life of the fund. Let's put it this way.
And back a little bit to the team. So the team is potentially managing what I would define as various verticals because they're really good. They're talented. They don't just need to focus on this one person for distressed debt or private credit, but maybe if it's a large enough allocation and important enough to the family, possibly. So there's a lot on their plate. And then you're making decisions along with them, maybe who to get out of, who to get into every year, being tactical, maybe somewhat, of course, mindful of taxes as well. 100 or even 50, that's a lot. Do you use a technological platform to help monitor this? Or do you have an internal system with Excel? How do you monitor so many different holdings and kind of know what's going on in each one at a glance?
Of course, you have an internal reporting that gives you visibility. But the way you should figure out this kind of situation or investments, it is an ongoing process. It's not that you just come up and then it's done and then you forget about it. You, especially as a hands-on CEO, which I am, I would describe myself as, you just follow the whole life of the choice, the due diligence, the whole process you follow, and you make sure that you stay on target in what you want to achieve, so that you can just say, okay, let's skip this opportunity without wasting too much time. So it is an ongoing process where you constantly talk to your managers in continuous meetings week by week for the liquid side, and certainly month or quarterly and so on, or both for the illiquid side. So you always know what your professionals are working at. And also you give your input in terms of strategic sectors that should be followed more, where maybe the asset allocation or the bucket needs reinforcement in a certain theme rather than what is already there. So it is an ongoing process.
Given that the world is turning upside down, I could argue we're turbulent times. That also creates blood in the streets. Blood in the streets creates opportunity for those, and maybe more in privates and real estate, for those that were over-levered. But that's also why there's distressed debt funds, there's private credit. What are certain verticals that, being tactical at the moment, and maybe private credit's one, that you would look at now as, if we have the patience and the money, now is an interesting time? Give us some investment themes and verticals.
I continue to, for instance, look at credit risk sharing opportunities in the private debt. I think that there are new opportunities in terms of direct lending. We have seen incredible opportunities here in terms of returns for the investors. As you know, the banks have retreated from providing credit and loans in many regions of the world, and private debt funds have jumped in. And I think that this means that, as you've seen in the recent last year anyway, we were talking about 13 to 15% returns, way above the expected average return for this kind of investments. I think that slowly one should go back in the liquid space into the metal universe.
Yes.
Something like copper looks very promising, lithium, uranium. There is a lot going on in this space. One could look, for instance, in view of the situation that we see in the US with some regional banks at sort of a foreclosure infrastructure, very specific kind of field. And also there is a global drone race going on. So in the direct investment space, that could be an area to further look into. I'm not at the moment looking at China for to pick up the so to say, the lowest levels after the corrections we have seen. I'm still very wary, and I want to understand if China is going direction Japan in terms of deflation after this boom in the real estate sector, and also the dirigistic approach of the Communist Party that we see with Xi Jinping. So I want to make sure that growth continues to be there before I jump into the market. So I do not do bottom fishing in that region. Rather look at India, even if the market has performed very well. I do believe that you have a secular story going on in that country, for instance.
I had a conversation with one of my multi-billion-dollar family offices who is effectively exclusively active in directs and private companies. So it's not a perfect analogy, but they gave me a couple of verticals that they're looking at. And some of them are because private equity funds, for a variety of reasons, sometimes regulatory and sometimes other, are not really active players in. Henceforth, they don't quite have as much competition. I'm going to name a couple of these sectors, and if any one or two pops out that, interesting, maybe a large enough family with patience could be interested. Renewable energy, alcohol and spirits, cannabis, gaming, which I find interesting, and the defense sector. Anything there that stands out to you is, I like that in today's market?
I actually I like all of them. Renewables, I haven't mentioned this because I think that we have, everybody is aware of the climate changes and the need to change the production of electricity all over the world. So renewables, of course, it's a clear investment theme. Cannabis, I can see that. Gaming as well. I know that this is more controversial and it's not for many ESG funds. Defense, it's a very important aspect. Also difficult for some investors, but the idea is that defense is necessary in order to defend our democracy. I do not go so much with alcohol, but it's just a personal point of view, nothing more than that. So I respect that.
I mean, Donatella, come on, I'd love to buy a limoncello company. If you have one for sale in Italy, let me know.
We'll let you
I'm
know.
in. I'll get the money together, I promise. Bring me your deal.
But I like these themes for sure. Yeah.
And in terms of, like you said, running a large family office, 100 plus LP investments, my audience is going to want to know how big, approximately, it may waver by one or two here or there, including yourself and only the investment-centric team, including analysts, about how big was that team?
The team I was heading, you mean?
Yes.
We were overall 20.
Okay, that's good size by family office standards. So that's a fair amount to support financially with salaries, perhaps bonuses. But again, it's relative. A multi-billion-dollar family that is concerned about their money, which they should be, and mitigating risk is going to want to do it right. Before I ask my next question, to be fair to you, as you can tell, I have a lot of questions, but I do want to be respectful of your time. Would you have 10 more minutes?
Yes, for
Okay,
sure. With
great.
pleasure.
I thought maybe you had a hard stop at the top of the hour. So out of respect, I was asking. For those of you that watch this on video, that will make no sense because you don't know, of course, what time it is. Back a little bit to all those managers. Some are going to cross over, maybe multiple long short, multiple this, multiple that. How do you know that they're not holding a lot of the same companies and you may be being a little bit repetitive? I understand they may get in and out at different times. It's complicated, but how did you address that issue?
That is a very good point. You have to make sure that the overall exposure to certain companies or sectors is not so big that it can derail your performance overall if something goes wrong. From my point of view, there is one thing also to say that actually it is much better to have pure investments in different themes and regions, and being the family office, the multi-asset manager. That is a much better way than taking a multi-asset manager. It is a very in and fashionable way of approaching and makes sense, certainly for many. But when you have a certain critical mass, then you can certainly become and be the multi-asset manager. You should be. You cannot expect also a liquid manager, for instance, to increase too much the cash levels. It can be maybe 5, 6, 7%, but no more than that, because it is not his job. His job is to be invested 100%. And the job of the family office and the asset allocator is then to reduce certain exposures according to certain evaluations and economic cycles and earning cycles. That is the way I see it.
And when I was in Vienna, where I saw you and you heard my interview with the Habsburg, a member of the Habsburg family, and we both met other generational families, there was a bit of a theme that was built around a foundation of back in the day, we owned land, art, gold, and gems. Now, you could argue land could technically produce income, but broadly, none of those have dividends. None of those are cash flow positive. But they represent a feeling of safety. They represent that they're tried and true. You could be tactical and look to trade it via maybe an ETF in certain of them, but for the most part, these are things that I would recommend that families have direct ownership of. We're not going to have the time to get into in your house, in a bank, or in the mountains in Switzerland and have a proper custody and storage, a different discussion for a different time. But in terms of the ownership of those sorts of assets, again, land, art, gold, and gems, do you simply leave it up to the principal, the family, to do their thing? Do you actively recommend direct ownership and understanding that in some ways it may be a bit of a drag on the portfolio, but it serves a purpose? What was your thoughts?
That's a very good point. Actually, I think that it's a bit a differentiated kind of aspect. Art is the question, do they have the expertise to invest in art? Yes, no. Or does the family want to own art? And then, of course, it's themselves that are going to choose what to buy, how to shape a collection. I think that there is quite a big difference, in my opinion, between a piece of art and gold or gems. I would tend to say that certainly it's a sort of especially the last, a safety net, and they can be certainly necessary also in the thinking of the overall asset allocation. I do not see any competition with the needs of increasing the portfolio and the performance if there is a certain percentage of exposure in these other asset classes that are for safety reasons.
Of course. And I'm going to name some other sectors, maybe a quick opinion. And by the way, it's more than fine to say, it wasn't what I focused on. The family wasn't as interested. It may be good. It just wasn't what we did. One would be very trendy right now, and that would be AI. So that could relate a little bit to your activity in the VC world as an LP. If you wanted to treat them separately, that's fine. VC investments, comparative to AI, is changing a lot of dynamics. It's not going to go away. I believe I heard a statistic in 2 years, it's going to be 800x more powerful than it is now. That's both interesting and scary at the same time. Why don't I get your feedback?
Look, I think that I tend to look at AI as an incredible opportunity. I just give you an example. I was just looking into this and discussing this today. Just think about the situation of many of the so-called Mittelstand, i.e. SMEs, around Europe. You have a situation of next gen, of the founders getting out of the company they founded for age reasons very often. So there is a lot of change, and you do it either this kind of, selling your company, i.e. monetizing your life's work through a traditional way, M&A, or you can use AI to really find the right matches for selling and buying. And that is something that if you can scale it up in the whole European region, that can really bring a lot of results. And I've seen some examples in other regions of the world.
Any specific thoughts about venture capital in general as an LP investor?
Yes, venture capital is extremely interesting as an investment, but you have as an asset allocator, in my opinion, to mitigate the risk. So I would see, for instance, a fund of fund approach as the better opportunity with a very seasoned GP in order to mitigate that risk. And in fact, there are many opportunities we know, but we also know that many opportunities can just fail. And that is the
Most
rule,
will.
unfortunately. And so I do not want to go into that situation if I can avoid it. And if I can just diversify in a way that I profit from the good entrepreneurs, and I do not have to see a failure in my portfolio and performance.
Perhaps not the greatest way to build wealth, but like you said, if the family's already rich, they need to preserve it. But being too conservative, not keeping pace with inflation, drawdowns of the money, taxation will decimate over time. It may take decades. So there's a little bit of the balancing act that, of course, you have to follow. But kind of the question is, if you're allocating small bits, you're sometimes going to miss out on pumps of one specific direct investment or fund. But what I'm basically saying is, could I argue how you mitigate risk is simply to mitigate or limit your allocation? If I'm investing in this specific vertical and strategy and it makes up 1.3% of my portfolio, I'm going to be disappointed if it goes to nothing. I might even have a glass of wine that night and be a little sad. But the impact on my net worth, I'm not going to feel it. Therefore, other than forming an incredible thesis and researching month after month after month after month and always adapting and changing, is it sometimes as simple as limiting your exposure?
No, you don't limit your exposure. You just create a diversified asset allocation. And, I can see the point where you say you just miss so much if you are so conservative. What does conservative mean? I remember that when I started the work at the family office, the real estate in Europe, in the DACH region, was just earning something like 6%. When I would say this to asset owners meetings, everybody would look at me, especially some investors from Asia, right?
Only 6%.
America, 6%, what is this? Why do I bother? So more or less. In fact, we have seen what has happened in other areas of the world. So wanting to earn a lot also means you also have a downside. And when that happens, you lose a lot of money. So why not looking at a decade with a certain return target that would allow you maybe to double the wealth entrusted? But of course, not just with ups and downs, but with a steady growth of the portfolio and the compounded return effect that will lead to this kind of effect. Because as a matter of fact, if you limit or exclude the drawdowns, you're gonna, per definition, gonna double your wealth over time.
Very good. Two or three final, we could go rapid fire questions. What do you think is the biggest mistake that most, and it could be investing centric, that's fine. The biggest mistake that family offices make?
I don't think that you can say you can talk about mistakes. Why? Every family office is different. Every asset allocation is different. Every principle is different. And well, you can lose money. That's a pity. Is that a mistake? We cannot say. So I'm not in a situation and position to say this is the biggest mistake. There can be many different aspects. The only thing is maybe what I would see is not making sure that whatever strategy you go for, it is not done by a specialist team that automatically would be ahead of the curve and really prevent you from big failures and total loss.
Right. No, that's very good. And among the most common questions I get, Angelo, how do I get a job in a single family office? We all know there's a limited number of single family offices comparative to the number of people that on the surface, reality may be different, but on the surface would potentially like to work in one. So let's put you back in the position again of the CIO of the family office. You're getting resumes, you're meeting people. What would make someone stand out to you to give them consideration?
Well, it depends what I'm obviously what I'm looking for. Um, um, I think that quite important is the aspect of being trustworthy and loyal. And that is based on the history. Of course, I would assume the professionality in a different field we are then discussing. But these other qualities are super important. And also being able to work in a team and
Yes.
contributing to that. There are at least what I always had a list of values, because you're not only a professional, but you're also working in a very specific or special kind of environment. And so the resources and qualities like communication, team spirit, of course, highest ethical behavior, and trustworthiness and discretion. These are all aspects that belong to the values that a family office should have and live.
I did have a question that I probably shouldn't ask because it'll open up a can of worms that we should do our part two in a couple of months or later this year on, but we'll whet the audience's appetite a little bit before I go to a final question about Italy. That'll be the fun one. But the little more serious one that will very lightly, we'll give it 2 minutes. And I think we're going to disagree somewhat on this. I'm more and more of an advocate as I travel the world, as I meet generational families, that the public markets are becoming very, very efficient. It's getting harder and harder. And now with the advent of AI and advancements to get alpha. And I'm really intrigued by the inefficiency of distressed debt of private companies. And I believe how families create generational empires is effectively by being active in owning directly. I didn't say through a fund, I said directly private companies. And I think we're a little misled, and you could yell at me, it's okay. Oh, it's too hard. Private equity funds talked me out of it. Well, of course they talked you out of it. They want you to be an LP. They don't want you to be a competitor. So I spoke to three family offices, each multi-billions of dollars. Admittingly, the principal sometimes is kind of a star, so they may have a little bit of that gravitas around them. And they're like, Angelo, you're right. We're actually surprised that more families are not active direct investors setting up a holding company. And we don't have a big team. We have a team of like 5 or 6 people. And what we do, we have our holding company. We got great tax advice. We buy cash flow positive companies with already a good team in there. And maybe 1 or 2 people get jettisoned. Maybe we need to bring 1 or 2 people on over time. But we have strong agreements in place and incentives with the people there. So they're part of our holding company. They're the operators of the underlying company, but our family office is not that big. And somehow we're doing multi-billion-dollar deals over time. I am an advocate of control and engaging the rising generation in the engine of wealth creation, that private companies get your hands dirty and they teach you how the world works. I don't think you should be 100% passive, but I know a lot of people are going to disagree with me.
Mhm. I would say we do not disagree at all. You have a great point. And look, you haven't been talking about startups or early stage growth companies. You're talking about cash flow positive companies, growth companies.
Boring, recession resisting companies. Yes.
Yes. So you see, you have already identified a great strategy, and you're right, you do not always need big teams. I've talked with the CEO of a very big family office of a billionaire, and I think there are 6 or 7, and they have an immense portfolio of direct investments. But it depends very much on what you're doing and what kind of investments you're looking for. And that is the differentiator, And also on top of it, you can also use outside platforms to perform certain duties within the due diligence process. So it can, it's not such a difficult situation. And we definitely do not disagree, Angelo. I'm with you.
I like it. In my close, I'll touch a little bit upon that. And my last question, and a little bit lighthearted, but we'll bring a little bit of the tax picture into it. You're the real Italian, Donatella. I'm 50% by heritage, going back about 4 generations now in the Abruzzi region of Italy. With a name like Angelo, of course, what do you expect? I think Italy's incredible. It's a great country. It has amazing culture, generally deemed by the majority. If you were to ask people around the world their favorite food, probably Italian's going to rise somewhere. It better be #1, I might add, or I'm going to come after you. Italy has so many things going for it. And now this gets unique for American citizens and green card holders, not you guys, but practically everyone else. It has incredible tax benefits, kind of what they deem to be called a multi-year tax holiday. If you could talk a little bit about Italy as being a hub for life, for culture, for family, and why it is getting better from a business and a tax perspective.
Mm-hmm. Yes. Well, I must say that I just came back to Italy after 33 years abroad 3 weeks ago. And why did I do that? I just needed this warmth. I needed the certain level of being Italian. I needed this kind of interaction and the beauty of the country. And I must say that I have a little bit problems now with my diet because I love so much being back. That I eat too much pasta, I must admit. The country, and especially Milan, where I live now, has seen, especially Milan, a lot of influx of foreigners coming from different European countries, but also from other regions, because the government has introduced some years ago a so-called flat tax that is extremely favorable for foreigners who become resident in the country, and they just pay 100,000 euro per year, and all what they own outside is not subjected to Italian taxes at all. And this has brought many foreigners to Milan, especially. That is the place where most of the people want to live, with the result, of course, that prices for real estate have gone up quite considerably in this city. But it has also made the city even more international, and there is a lot going on. So it's a vibrant place at the moment. And on top of it, you have also a little bit of, if you like, renaissance of what is meant to be entrepreneurial families. And this one is also something which is part of an overall European kind of development, where you have the next gen coming into the family businesses, and where there is a rejuvenation and a renewal, and certainly also an analysis of what it means doing business from Italy. What is missing at the moment, as far as I could see, is a startup ecosystem. But I've already met some brilliant minds, and what I've seen is that they have different companies, very technology driven, and they just look. They work in Italy, but they also integrate teams in America, which continues to be the market for the innovation, and also teams in some other countries in Europe that work together and bring together a very strong platform. So Italy is part of a whole, if you like.
Indeed, lots of questions I would have, not just on Italy, but broadly in Europe. Europe compared to the US, I think there's advantages and disadvantages. You mentioned a great strength of the US, and part of it's Silicon Valley and the wild west of America and cowboys, and a very independent spirit that allows for the freedom to be an entrepreneur, to create companies and to fail and almost have it be a little bit of a badge of honor and then do it again. Where sometimes in more traditional and more regulatory centric environments, like most of Europe, that is sometimes, I don't know if I'd use the word frowned upon, but there's more in your way in terms of doing that. But there are advantages, you could argue, food and culture. Some would say lifestyle. We could save that for a part two and do a little bit of a deeper dive. I do want to be respectful of your time. What I said 10 minutes, 23 minutes ago, ended up being 2.5 times longer than I promised the final quote unquote 10 minutes to be. And yes, I did have to leave some questions until next time. We didn't get into real estate and some other topics that we'll save for a future time. For those that would love to learn more about you and follow up with you, how could they do so? How could they learn more, and how could they potentially reach out?
Well, I have a LinkedIn profile. Either they come through you or they just write to me through my LinkedIn profile.
Yes, and everyone, and you'll find this a little more in Europe. Unlike us salesy Americans like me, Donatella is very low key, not really looking specifically for anything, probably doing me more of a favor by coming on, but hopefully that says a little bit about me too, but more so a lot about her and the value that she brings to the table. By the way, it's Donatella, Donatella, and her last name, Ciccarelli. Finally, I pronounced someo's last name correctly, I hope.
Yeah, congratulations.
You think I could at least get Italian names?
One of the few. You're one of the
few. Last name is spelled Ceccarelli. At minimal, like she said, look up on LinkedIn. Maybe she posts once a year, a couple of times more frequently. Who knows what the future might hold? But definitely recommend the follow. So we greatly appreciate Donatella being an incredible guest and very much look forward to hopefully once or twice a year being on, because I got hundreds of questions and the world is changing so rapidly. Even some of these similar questions 6 months from now could be very different. So my two parting thoughts: one, representing both me and Donatella, thank all of you, and a reminder, some would say a disclaimer. Whenever you invest, there is something that could happen that means you can lose money, maybe all your money. You need to decide on your liquidity, your risk tolerance, and there's so many different factors. You're also listening to this now, but the now to you may be in a recording a month or a year or 2 years from now. Myself and Donatella might have totally different perspectives because time changes everything. So this is for entertainment. This is for engaging in conversational purposes. But at the end of the day, and timing, of course, is everything, you need to think for yourself and you need to make your own decisions. My final comment: it's been great to have Donatella on. I look forward to going back to Europe and hopefully seeing her in my ancestors' homeland of Italy sooner rather than later. And I hope you enjoyed a lot of our conversation today. So again, I love to do things for free and give back to the community. I love what I do with Family Office TV, to some degree traveling the world, doing amazing interviews and shedding a light on an opaque industry where a lot of people don't go beyond the vanilla, don't go beyond the boring, although I actually love vanilla ice cream. It is my favorite. Or gelato, how about that, Donatella? And taking things with deeper critical thinking and a deeper perspective, I take pride in. Does that sometimes make me unlikable and not the most friendly chap, according to some of the community? I really don't care. At the end of the day, I love what I do and I want to provide value. But for those of you that want more than just the occasional interview, I am extremely active in my love and ownership of Family Office Masterclass, where I do shine a spotlight on an industry that you probably don't know that much about, even if you're working in one. Could you admit that you could be better? We all could be better. Our competency, identifying blind spots and moving ego aside. I am imperfect. I have my faults, but I've been in this community for 20 years. I think I might have learned a thing or two. I know thousands of family offices, probably 200 very close, and I traveled the world multiple times over and met with families and created or reimagined dozens of family offices. I'd like to hope that I may have a little to share. And my revamped masterclasses are an incredibly effective and cost-effective way for you to obtain the knowledge. So as I'm now recording this, it's a little bit of a work in progress on myangellorobles.com. And one day, and yes, I do own it, at familyofficemasterclass.com. But I would say by the spring, mid-spring, somewhere into April, not too far off, when you go to angellorobles.com, in my masterclass tab, you'll be able to have 24/7 access to a series of multi-hour, deep masterclasses that I think are a standard, I guess you could say, in the industry. I've been to all the university programs, or most of them. I know people in the community. I love them all. I learn from them. But sometimes the advice is a little down the middle and it's not practical. It's not the reality of what it's like day to day, not just talking as a professor in theory, but working in and advising and creating a family office. And my strength is going to be practice management. How do you go from average to good? How do you go from good to great? And I would say practically any family office can make those incremental improvements. So I'll name two masterclasses that will be up in my platform, either live or as digital access 24/7. And yes, for a cost. I have unique, valuable intellect and content that provides value and would be very helpful. One of them is how to create or reimagine into a top 1% family office. Okay, maybe that's a little over the top. I said greatness is top 3%, but why not aim to be the best, right? Why have a family office if you're not going to be great? So in relatively a couple of short hours, I basically share most of my secrets about how you could do that. And a lot of that comes from incredible family office and executives like Donatella that I've known over the years. And another one, and then I'll stop, that relates to kind of among the final questions I asked Donatella, is how to implement a direct deals strategy inside your family office. And I went deep into that. and I have 5 guest faculty members that contributed. One ran for an iconic financier, multiple billions of dollars in private investments, and was incredibly successful. The insights he provided, that was alive last night. So it's gone as a live digital, but it's going to be part of downloadable or 24/7 access in my archive for those that want to be more active in my master classes. That alone, forgetting what I said, or even what other key faculty members said, is worth 100x what I basically charge for it, to be honest with you. But then you couple everything else, the amazing attorney, how to source deals and other people, and how to do diligence. But really, it's how could you kind of create, like Warren did 50 years ago, kind of the next Berkshire Hathaway on a mini level, and the opportunity of holding companies and learning how to source and negotiate and terms. I go deep. It's 4 hours and it's intense. So my master classes create an opportunity for you to enhance your skill set, your capability, and that's just 2. By the end of the spring into early summer, there'll be 7 up there. And then I'll probably hit a little bit of a pause, do some in person, do some consulting, and then maybe later in the year or next year, introduce another masterclass or 2. So simply follow me on social, including LinkedIn, where I'm very active. But to really understand and integrate yourself in what I do, go to myangellorobles.com, especially come mid-April, but even now. And you'll see how we're going to evolve what I'm doing on Masterclass, my tab there, and my direct deals, and the opportunity for you at your convenience 24/7 to have access, if you're a subscriber or a participant, to extremely high quality content that is not just me, but a dream team. Honestly, part of my conversation today with Donatella, I probably should have done more privately and packaged that up into a 3-hour type masterclass about, how to be an effective CIO in a family office. So all of you should be happy that you got some incredible content, not from me, from Donatella, effectively for free, because we do feel an obligation to give back, to help people, to shine a little bit of light on an opaque community. But for deeper knowledge, reach out if applicable to one of us. And again, follow me again at angellorobles.com, at my website to learn more about my masterclasses, which I love. Sorry, I went a little longer than I normally do on a close. And how many of you will see this, I don't know. But those of you that will, I want to provide that value and that information back to you. Sorry, I had to keep you on an extra 6 or 7 minutes, Donatella. I hope you enjoyed our conversation. I learned, as always, so much. I greatly appreciate you and look forward to the next time I see you in Europe, specifically in Italy, I'm sure.
Thank you so much, Angela. I enjoyed very much the conversation, and I just say goodbye to all listeners and the public.
Us Italians are pretty good talkers, aren't we? It's in our blood. What could I say? We're passionate and love what we do. Have a wonderful rest of the week and weekend. Look forward to hopefully seeing you in a couple of months. God bless.
You too. Thank you. Thank you so
Bye-bye.
much. Bye-bye.